will be focusing in this module is investing, how to spot multi-baggers, where to buy them, and what are the triggers that will help us to achieve those multi-bagger returns in smoothest way possible. You should do value investing when you find yourself a risk-averse person. As Mohnish Pabrai says, a value investor is someone who makes good when he is right, but who loses very, very less when he is wrong. And that is what separates a good investor from a bad investor in the market. As a value investor, you focus on well-growing businesses, quality businesses, but you are rigid about the valuation you are paying in the market. I'll give you a lot of examples like FIAM Industry, GNA Excels, now Bharat Venture, how we made multi-bagger returns in those companies. I'll be sharing case studies of those companies with you also. So I will start this module with a 13-year case study that I did on the market. We took multiple parameters like sales growth, capex growth, profit growth, cash flow growth, 4 in growth. Then in quality, we took ROE, ROCE, ROA. In valuation, we took P by E ratio, P by B ratio, price to sales ratio, P by S, and P by CF. And we plotted these parameters against the stock prices, CAGR for last 10 years. So this was a back testing that we did on the stocks against their parameters. We did not stop there. We went ahead and did a 3-year forward testing, and whatever the results are, I will show you. The case study will pave a way for you so that you can find good quality companies, good potential multi-bagger companies by doing a small exercise that is based on data and not stories. So just to give you a basic idea, what is capex growth, what is sales growth. Now capex growth is percentage growth year on year basis, capex that companies are putting in their businesses. Sales growth is yearly growth in the sales, which leads to profit growth, which is year on year growth in profit, which further leads to cash flow growth, which is year on year cash flow growth. Similarly, as we calculate ROI, return or R investment, companies also calculate returns on their investments, which are called ROE, return on equity, return on capital employed, which is EBIT on capital employed, which includes equity plus debt, and return on assets, which is net profit on net assets the company have. The valuation parameters I talked about is price to earning, which is market cap divided by profit after tax, price to sales, market cap divided by sales, price to book value, market cap divided by net worth of the company, and price to CF, which is market cap divided by operating cash flow. We analyzed 2,500 companies based on these parameters and other parameters also, and this is what we found out. So here is a chart of sales growth versus the CAGR for those 2,500 companies for last 10 years. As you can see, the x-axis is sales growth and y-axis is CAGR. As you can see in this chart, as the sales growth is increasing, so is the CAGR. So the chart is putting a very good tone here. But you can see a lot of times where the sales growth is high, CAGR is not. And there is a lot of time CAGR is high, but sales growth has not been high in those cases. Now, where the sales growth is also high, CAGR is also high, you can call it a win zone. And where sales growth is low, CAGR is high, or sales growth is high but CAGR is low, we can call it a lose zone. I have indicated them in green and red respectively. As you can see that sales growth is a great parameter to find good companies, multi-bagger giving companies, but it also has a lot of loose zone. It means there will be a lot of time you will not find it to be working for next 10 years. The second chart shows ROCE and CAGR. ROCE is on x-axis, CAGR is on y-axis. As the ROCE is increasing, the CAGR is also increasing. It's also setting a very good tone here. But as you can see, if I put red zones and green zone here, you can see there are a lot of companies which have good ROCE and good CAGR, but there are a lot of companies where good ROCE and bad CAGRs are there, and bad ROCE and good CAGRs are also there. The same chart you can see for profit growth and CAGR. The respective win and lose zones have been indicated. The fourth chart you can see is price to earning and CAGR. Now a lot of value investors, they talk about the multiples like P by E and P by S, and they always find value in low multiples. In this chart you can clearly see there are a lot of companies which had low P by E and gave great CAGRs, yes, but there are a lot of companies who are showing the results otherwise. It means they had less P by E, but they gave lesser CAGR over the years. So it also means that lower multiple is not the answer. It's not a holy grail, as a lot of value investors show. So when we did these parameters versus CAGR plotting, we found out there is no one parameter which is a holy grail in the market. So instead of one parameter, we started doing two parameters at a time. So we started doing fusion. How does this fusion work? I will just tell you in 2 minutes. So you take, let's say, 2000 companies in the market, or let's say you take 200 companies of a sector and you rank them on the basis of ROCE and EV by EBITDA. Formula was first suggested by Joel Greenblatt. He called it a magic formula. Now you rank all the companies basis of ROCE, you rank all the companies basis on P by E, and then you add those ranks and you have the final ranking within the sector. So you take top three companies, top 5 companies, and you do the detailed analysis and you take positions in those companies. So just like I showed you in the example, now I'll talk about the results of the same. Now this is the magic formula, CAGR versus parameter. As you can see, there are a lot of companies which have given good returns, but there are some companies which are in the low CAGR zones. The best thing I find about this fusion is you only think about top 50 to 100 companies. You don't talk about the rest 2400 companies. So I have put them in the gray zone. As I used fusion more and more, I found out that the green area becomes larger and the red area becomes smaller over the time. Some of the other fusions that I have used are sales growth and ROCE. Now this is the chart of sales growth and ROCE, sales growth and P by E, and sales growth and other valuation multiple like P by S, P by CF, and profit growth and P by CF. So I'm only showing you the significant ones here. Now one fusion that intrigued me and I made that intrinsic value ranking was sales growth, ROCE, and price to book value. As you can see in this chart, with a small amount of due diligence, this is the chart for first 50 to 70 companies. Last 10-year backtesting showed me a great CAGR of 40.9%. But I did not stop there. I wanted to do a forward testing on the same. And when I did forward testing on the same for 3 years, the returns were extraordinary 70.4% for next 3 years. Now there are some pros and cons for this formula. The pros are that it covers all the important aspects. As you can see, we have covered sales growth, we have covered ROCE, and we have covered the valuation part, which is price to book. Second pro is that 40% is a very great amount of returns, and 40% means 30x in next 10 years. But we will discuss the cons of this strategy also. First, we have included all the stocks. We have not excluded even the penny stocks, because with the time we have seen there are a lot of small caps and mid caps which become penny caps over the year, and there are lot of small caps and micro cap which become mid cap over the years. So we have not excluded any stocks from this study. Now the second is, lot of times we assume that fundamentals kick in first and then the stock price performance comes. But it's not the case. As you can see in the market, a lot of times before the fundamentals, stock price booms, and it starts happening from last 1 or 2 months itself. So these are the two assumptions that we have made. Now to eradicate those assumptions, to improvise the strategy further, we did one thing, that we started using this strategy in undervalued sectors, because a lot of times the fundamental kicking in after and the stock price booming before happens in the hot stocks, the stocks that have already performed for last 2 years, 3 years. Now by doing this, we have eradicated one assumption, which is fundamental kicks in first. The companies which are not hot, which have been undervalued, we have made sure that the fundamentals kick in first and then the stock price boom comes. So the final intrinsic value framework comes. You go to sectors which have underperformed a lot for last 4-5 years, the sectors that are undervalued. You find the stocks based on the ranking formula, based on sales growth, ROCE, and valuation, and then you remove the companies which are having market cap less than 200 crores. So this ranking system will give you a clear-cut process how you can find out quality stocks, how you can find out the potential multi-baggers in upcoming years. So this process clearly shows you how you can find out potential multi-baggers just looking at the data and not going into the narratives. Giving you examples, in 2019, when auto sector was way undervalued, we went for the same ranking system. We ranked the companies based on that. And for top 6 companies, we found GNXL, we found FIAM Industry, we found IST, we found Precision Craft, and 2 others. Now, when we looked at the fundamentals of those companies, we found FIAM Industry and GNXL very good fundamentals and very attractive valuations. We went in deep in these 2 companies. We took holdings, and both these companies gave us multi-baggers 6x and 8x nearly returns. Now, what was the reason we looked for auto industry? Because in 2019, if you remember, there was a regulation issue from the government, and that is why the whole auto sector was correcting. When the whole auto sector was correcting, auto ancillaries were the one who were taking the biggest hit. Companies like FIAM Industry, GNXL, they were down for about 50%, 60% and more. These companies were growing with a steady pace for 20%, 21, 22% for last 5-7 years, and still they were taking a biggest hit because of these regulatory issues. Now, auto companies were also taking hits, but since they are retail facing, their valuation were still premium. But these companies which were B2B based, FIAM Industry and GNXL, they took the biggest hit. The stocks corrected 50 to 60% also, and the valuation we were getting were worth the value we were getting. And this is why these 2 companies became our primary choices, and they gave us very good returns also. Still today, some analysts are finding value into these companies. We are still holding FIAM Industry. Meanwhile, we have made returns in GNXL and exited it. This is just an example. This is not a recommendation to take any action. If I talk about the second example, it will be in the real estate companies. Now, when the real estate were showing some kind of revival in 2020, we did the same exercise with multiple companies in the sector, and the companies we found out from those rankings were Arvind Smart Space, Marathon NextGen, Ajmera Realty, and so on. When we went into deep, we found that Marathon NextGen has been consistently increasing its market share and consistently giving sales growth year-on-year basis for last 5 to 7 years. It has been doing well compared to other industry leaders and compared to other industry players. And this is why we liked Marathon NextGen. In 2021, the price was 56 rupees. Today, it's trading at nearly 400 rupees. Now, this is why I call it a pure quality investing. You are buying a sector which has not performed for last 6, 7, 8 years also. But in those sectors, there are gems which have been doing well compared to the industry and despite the downturn or the headwind of the industry. So when the sector's tailwind comes, these companies are bound to give you multi-bagger returns compared to others. Now, when you do the same exercise in hot stocks, in sectors which are hot, you don't get good returns. Let me give you a disclaimer here only. Because most of the times in hot sectors, in trendy sectors, the stock price has already taken effect of all the fundamentals that are going to come for next 2 years or 3 years. So this is always advisable to use this ranking in the companies, in the sectors where there has not been any tailwind for last 3-4 years. So this ranking system will pave a way for you to find quality companies within all the sectors. Now, we discussed 4 cases in the starting of the video, and I call them curious case of retail investors. You buy high, stock corrects. You buy at correction, stock corrects further. You buy a corrected company, stock doesn't go up, and you exit a laggard and stock becomes multi-bagger within a year. Why does this happen? I'm going to talk about in the next video.